Hello and welcome to Your Trades, a Diwali special with me, Neeraj and Ayesha, wherein we try and get you a synopsis of what the year gone by has done and what the year ahead could look like.
But before anything else, here's wishing all our viewers a very happy Diwali from both of us.
Okay, so what do we do on the show? We quiz a very special guest on his views of what the market is doing right now and what it could do over the next 1 year. Needs no introduction, but Nikhil Vora, MD and Head of Research at IDFC, joins us right now on the show. Nikhil, good having you. Thanks so much for taking the time out and being a part of the show.
Pleasure.
So what's the broad sense now? The year gone by has been turbulent to say the least, and the year coming ahead promises to be turbulent one as that, with lots slated, the budget, possibly early elections, and lots more. What's your best case and the worst case scenario for the markets?
Okay, firstly, a very happy Diwali to every viewer out here. It's interesting. My sense is that India is not as great as it's being made out to be, but it's not as bad as we think it is. So, firstly, the reality is somewhere in between. Whatever we've seen in the last year or last couple of years, I think it's something which has been anticipated for quite some time. We as investors tend to overread at a lot of stages. We've been talking about government inaction and stuff like that. I think, frankly, the more one looks at it, it looks more of private sector inaction rather than the government inaction. The fact is that if you look at private investments in the country, the balance sheets of most of the private players in the country has actually not expanded in the last 3 to 4 years. So maybe in retrospect, it's a very positive thing to happen because you don't want balance sheets to expand when interest rate environment was just going berserk. You've seen literally 700 bips increase in interest costs in the last 3 years, and you didn't want balance sheet to expand. So I think, in a summation view right now, while there are moving pieces across the board, and these moving pieces are something which we've not seen for a long time, I think the fact is that the stage is set for corporate India to now start really to push the button. I think you will look at a scenario where India Inc. is a lot more comfortable with the environment around them. They're a lot more resilient. And if the corporate spend starts to happen now on the back of what government has at least laid out as a roadmap, I think it will be a very positive move forward. My sense also is that, investors have eventually got fatigued out of bad news. So incrementally, I think while that's great news, bad news for media if they don't have bad news generally. But I think for investors, it's perfectly good now that no longer is negative news perceived as badly as we think it ought to be. So my sense is that, as you move forward, for investors in general, they've got to look at what value really lies underneath. There's one very interesting data which one finds. You look at the last 15 years since the Asian crisis, and you look at $1 billion plus market caps in those companies, and across the top 15 performers in Asia in the last 15 years, 80% of those companies were Indian companies, right? In the last 15 years, and this is despite the fact that the last 4 years in India has been literally a non-performing year. So the fact is that India has always been a bottoms-up story. And that never required a second reasoning. And to me, that story continues as you move forward. So bottoms up is very well established. Top down, like I said, we have a lot of support coming in. There is the fact that corporate India is a lot more resilient. There is the fact that interest rate environment, if any, as you move forward, is likely to be more supportive than on the other side of it. So I think there is a lot more hope and optimism that you can start this year with than what you have possibly had last year.
Nikhil, that prompts me to my next question. When do you think we will see easing of interest rates? Because that could incrementally at least help ease sentiment on the street as well.
I totally agree. I think, and we've been in the camp which thought that interest rate will start to really cascade down as we get into this year. I still believe that that's the way it will move forward. Obviously, the RBI governor doesn't think the same way that we do. But my sense is that, there has been so much of underlying support for the economy where, the fact is that bank interest rate actually is lower than what it used to be 6 months back. So I think there will be some amount of cuts that you will see in the next, maybe in the next quarter or so. The fact is that cash to balance sheet right now is actually at the highest level in corporate India. So beyond a couple of pockets, which could be SEBs and aviation and maybe infra, beyond that, corporate India health is not as bad as being made out to be. So I would think that interest rate will clearly stimulate the environment for private sector to start to spend a lot more money. Government has been a lot more supportive. You've seen fair bit of noise being made in a lot more transparency across the board in projects, be it roads, coal, power, and so on. I just think the way ahead is a lot more smoother than what we think right now.
So this Diwali to next Diwali, or this somewhat to next somewhat, what's your sense of where it could be? I'm not asking for specific levels to the point, but do you think it could be 5, 10% higher or 15% higher than when we are right now?
Well, like I said, I think let's go with a base level where we think that the index might remain in a range for the near term, which could be the next 6 months odd. But within that base, there are a lot of opportunities underlying it, and that's what investors really need to focus on. It also makes the job of people like us slightly more tougher because we're not really buying into a trend. The trend is not necessarily all clear. But it's also the reason that you need to really look at a lot more stocks underlying. And I just think that just as you saw a lot of opportunities in the last few years, which you had opportunities to make 30, 40, 50% compounded return, I think you will continue to have those opportunities as you move forward. So the focus of investors need to be on stocks rather than looking at what the market really will do in the next 1 year.
Any near-term triggers or any near-term events that could dictate how the market moves?
We all keep waiting for near-term triggers and stuff. We keep looking at option curves which evolve every time. I remember last 3 strategy reports that we've done, and these are slightly differentiated reports and work that we do. We're not really brilliant economists, so we don't really pretend to be one. But we did one which was called Remembering Marilyn Monroe, which basically said that if you can't handle me at my worst, you'll surely not get me at my best. And markets have done pretty much what we thought it should. We did one called Saat Khoon Maaf, which was about the 7 cardinal sins. We talked about how each of these sins can literally blow up the market, and we still thought it's good to really forgive all those. And that's pretty much, again, how markets have really done. We've done one recently, which was about saying that India is a stock, the country is a stock, and how stocks go through a derating and re-rating process. And similarly, how the country will go through the same process, where we think certain variables will come in play, and that will look very positive as you move forward. And change in management, which was change in governance, in this case was the finance ministry and so on. And that's pretty much played out as we look at it. So one is, there's not necessarily a singular event which one needs to wait out for, but that's the trend that one will look out for. So if I look at the next maybe 3 to 6 months, there are 2 things that I would wait out for. One is from what the government we should expect, and second is what one should really look out from the private sector. From the government standpoint, I think there are a couple of things which are already in play, which one hopes becomes more actionable as you move forward. So setting up of the NIB, I think that's very critical, and that will possibly see a lot more fast clearances of large projects, and that kickstarts government spends in that market. Possibly a movement towards GST, and I sense that current finance minister is likely to push this through before we really get into the next year's election calendar and so on. So I think there's a lot more hope that GST will get pushed through, and that will help a lot of corporate across the board. And maybe there could be some more reforms on the Banking Act. So I think these 3 would be what I would expect the government to really follow on through. The natural process is to look at private sector then. My only grievance against the private sector is that they've literally been waiting for the government to act before they come in play. I think government's done a fair bit of its own. I think this is the time for private sector to really invest capital. If one has to look at GDP spends and infra spends and GDP being at around 10% odd, I can't see that happening without the private sector really pulling up. Private sector is literally half of the infra spends, and if that's hitting a ceiling, I think that's something which would be worrisome.
Nikhil, going by the names of your reports, I'm sure you have a personal interest in movie exhibition stocks. I'll come to that a little later, but one can't help but ask you about ITC, and the company has clearly defied your thoughts in their second quarter performance. Continue to remain bearish?
Oh, I'm structurally bearish. Let me just qualify that. I think these are consumer stocks are businesses which don't tend to drop off in a quarter, in a year. It doesn't. And we are very well aware of that. I think we are playing a structural down rate and a D rate in ITC and in a cigarettes business per se. And this is something which one has been sensing a lot more. This is something which happened in 2003-04 in the world, in India, where every segment was against cigarettes as a lobby. You saw consumer state-led litigations. You had farmers uprising at that point, where farmers were told not to grow leaf tobacco and move into other forms of food crops. And they were subsidized by the US government, which fundamentally was taxing the BATs and the Philip Morris of the world. So I think, and you saw derating happen where these businesses got valued on equity returns, which were dividend yield at that point. My fear is that this time around, it's a lot more stringent. It is not about litigations. It's about consumer-led movement, where governments in Australia, in UK, in Canada, in New Zealand, in Russia, in 30 other parts of 30 other countries, they are saying that we cannot allow smoking pop to increase. We cannot have our population start to degrow. We cannot have women smoking being 30% of our entire smoking pop. So I think there's structural damage which is starting to get created. These damages take a lot more time to happen. But my sense is that while nothing of this construct will happen in India, the derate of BATs and Philip Morris of the world is a reality. For the first time, and that's interesting, you look at the last couple of months of what BAT and Philip Morris and Japan Tobacco has done, the stocks have been down by 15% globally. And this is the normative return that these stocks give in a year. So the stocks are starting to react. In Indian context, given the variability and the uncertainty of the market, people seem to be comfortable with a 15-20% earnings growth story, which is what IDC gives you. My argument is not about saying that 15-20% is under threat. That's not the argument. My argument is that, firstly, this is a global derate business. Second is that ITC is not a pure consumer play. 75% of ITC's balance sheet is capex driven, which is a price to book business. Hotels and paper are price to book businesses. It's a consumer business. I think for whatever I understand of consumers, I think ITC actually doesn't necessarily know how to run the consumer business. I haven't seen any company in the world spend close to $1 billion on balance sheet, lose $700 million on P&L, and not have more than 10 to 15% market share in any category that they
So
operate.
what's the 12-month price target in ITC?
I think the stock will remain in a range. Like HUL or Hindustan Lever remained in a range for 10 years. It remained derated for 10 years. It's not that the business did not grow. I think ITC will remain derated. So while we've seen some leg up for ITC in recent times, my fear is that investors will not make any absolute return in ITC over a period of time, unless this gets reoriented.